Selling your business is one of the most significant financial decisions you'll ever make. Whether you're planning retirement, pursuing a new venture, or simply ready to cash in on years of hard work, getting the sale process right can make the difference between financial success and disappointment. I'm Malcolm Zoppi, an English qualified M&A solicitor, and in this video, we'll discuss what is the best way to sell a small business in the UK. We will go over three main things. First, whether to use brokers and how to maximize your valuations. Second, how much to budget for legal fees and how to structure your sale from a legal perspective. And lastly, the taxes that you need to be aware of and how to minimize those tax liabilities. Fantastic, let's get started. So chapter 1 is whether to use brokers and how to maximize your valuations. Starting with brokers, there are a few advantages to making use of a broker. First, they save time as they screen buyers, organize documents, and coordinate meetings. Second, a good broker may attract multiple buyers, increasing competition and therefore driving up the sale price. And lastly, typically, there's a higher chance of the business getting sold if you're using a professional. But there are also disadvantages to using a broker. First, brokers might want a quick sale as opposed to the best sale for you. Secondly, there are fees, a commission, and upfront marketing fees without any guarantees that your business will sell. And lastly, typically you'll be signing an exclusivity agreement that forces you to pay the broker even if you found a buyer by alternative means. A few questions that you might want to consider asking a broker to understand whether they are the right broker for you is: number one, how would you market my business? How would you find buyers for my business? And what kind of buyer do you think will be good for my business? And secondly, percentage-wise, how many of the businesses that you take on get sold, say, within 12 months? Okay, if you want to learn more about brokers, make sure to watch this video right here. But now let's move on to valuations. There are three main ways to value a business, typically used when it comes to small businesses. First is asset-based. So you take the assets, you deduct liabilities, and that's your net asset value. Second is the earnings multiplier. So you multiply profits by your industry standard multiplier. And lastly, the discounted cash flow method. So here you discount future earnings back to present value. That's because typically a pound tomorrow is worth less than a pound today. If you want to learn more about valuations and how to maximize each valuation, make sure to watch this video right here. But generally, if you want to improve your business's valuation, you should do two things. Number one is try to find a way to guarantee revenue for the business, ideally by having contracts in place with clients that guarantee purchase orders. And second, evidence the fact that the business can function without you. Show that there is a system in place, there's a team in place that doesn't need you to stay with the business. Fantastic. Let's move on to chapter 2, which is legal fees and how to structure your sale from a legal perspective. Starting with the legal fees. So usually these start at around £8,000 to £10,000 plus VAT, and then it's 1% of the sale price. So for example, if you're selling your business for £3 million, then probably the sale fees will be £30,000. Okay, moving on to how to structure the sale from a legal perspective. You have two main options: share sale versus asset sale. So usually sellers opt for share sale because you're selling the entire limited company. It's a cleaner break. You just give them the entire company and you get money. If instead doing asset sale, you might be left with liabilities because the company itself stays with you and potentially unknown liabilities as well. And then certain assets pass to the buyer. Further, you'll need to worry about closing down the limited company and ensuring compliance with that process, as well as taxes for both the limited company that's selling the assets and taxes when extracting the money from the limited company to yourself. But before we go in more depth regarding the taxes to consider, feel free to email me if looking for professional legal advice. With our legal advice calls, there are no charges, no obligations, and no nonsense. Contact me now at info@zoppi.co.uk. Fantastic. Moving on to taxes to consider. The first is capital gains, which might be payable on the increase in value of the shares. Second, there might be VAT payable by the business when disposing of assets as part of the asset sale, but usually this is avoided by arguing that this is a sale of a business as a going concern. Third, there might be income or dividend tax obligations when extracting the money from the limited company as part of an asset sale. And lastly, you might have to consider corporation tax because the company might have sold assets at a profit. As mentioned, share sales are usually preferable because you would only be concerned with capital gains tax, which can be minimized to a minimum of 14% via the business asset disposal relief. If you've got any questions, feel free to put them below. I promise I will answer them. But if you want a more in-depth look at how to minimize your tax liabilities when selling a company in the UK, make sure to watch this video right here. Thank you for watching.